All right. I think we've got enough people to get started, Brittany.
Yeah, no, not a problem.
Sweet.
Okay. Ty, do I have the capability to share my screen or? Oh, yes, I do. I just hit the button. So yes, I will be
Yeah.
able to. All
All
right.
right.
Cool.
Do you want to maybe just introduce yourself real quick for people that might not know you?
Sure. Yeah, no, not a problem. I can. Hi, everybody. I do recognize some faces, some I do not. So if you haven't seen me before, hi. My name's Brittany Green. I am a certified valuation analyst and co-owner of Green Appraisal. We are located in Houston, Texas, but we work on a national basis doing valuation, due diligence, and business planning for people on both sides of the deal, as well as we work with banks, gifted estate tax planners, financial advisors, all those folks doing, estate planning, gifting, um, estate, but all those fun things and buy-sell agreements and business divorces, you name it, except for an ESOP, and I got you. We help in those areas. So today we're going to talk about, let me get this, I'm going to share screen one. So you guys may see yourselves for a second until I should get this all situated. So, and then we're going to swap. Okay. Does everybody see a screen that says realities of SDE and add backs? Thumbs up. Okay, cool.
Yep.
So, when Ty contacted me the other day, he was like, hey, can you do our weekly call on business valuation? I'm like, absolutely. I was like, but what do we want to talk about valuation? Because business valuation is, there's so much to talk about in here. And I think I was telling Ty, I think this is my fifth or sixth presentation with you guys, which is why some of you guys look familiar. So I love that you're still here and you're not annoyed at my voice yet. So thank you. But what we're going to chat about today is something that has kind of become almost a crusade, but it's also conversations I have not only with buyers, but sellers as well as the bankers. And that is realities of SDE and add backs and how it can impact the value. So just did a little bit of explanation about myself, certified valuation analyst, certified financial data analyst. My degree is actually in business analysis. So I'm actually a business analyst. I'm an instructor for the Texas Association of Business Brokers. I teach a 4-hour class on basics of financial statements, how they interact into business valuation. And in my free time, not that there's a whole lot of that, I am the co-founder and president of the Clear Lake Ladies Night Out, which is a women's nonprofit here in Houston. We host a different event every month to benefit a different nonprofit. So last year we raised just under $10,000 for local nonprofits in our area. This year, hopefully we crack 10,000. That's the goal. So now, what is the difference between SDE and add backs? Essentially, SDE and add backs, they kind of get interchanged as far as the usage. So sometimes you may talk to somebody, they're like, oh, the seller's discretionary earnings is this, the add backs are this, and they're kind of using them interchangeably, and actually there's a considerable difference between the two. So SDE at its basis is a seller's discretionary earning. Now, this is a measure used to determine the total financial benefits available to you, the owner or the operator. So everybody here, their goal is to be a owner of a business. So what are those total benefits that are available to you? It's going to be the pre-tax earnings before deducting compensation for the owner, interest, taxes, depreciation, amortization. Everybody loves a good EBITDA. But it's after adding back certain discretionary, non-operating, and non-recurring expenses. Okay. So that's specifically what add backs are. And we're going to look at some examples of what different add backs are before we finish. So seller's discretionary earnings reflects the cash flow available to the owner to cover their salary, any perks that you have, any benefits that are going to derive from the business. Okay. It's often used for valuation of small businesses, especially with a single owner or a small ownership group. And based on conversations I've had with various folks in this organization in the accelerator program, you guys are all going for either single owner or, small ownership groups. So you guys are going to deal in SDE quite often. Now, what are the add backs? The add backs are the specific adjustments that we make to the financial statements. And when I say we, That is typically done by an accountant, a CPA. Sometimes the business broker will handle it, but us as the evaluator, we don't determine what those add backs are ourselves. Okay, those are going to come from conversations with the owner, again, accounting professional, or their broker. Okay, this is going to normalize the financial performance of the business. So add backs typically involve identifying and adding back expenses that are one time, non-reoccurring, discretionary, which can also mean personal use in nature, and not reflective of ongoing operations in the business. Okay. Common add backs include salaries that are above market rate. Okay. So the owner, a lot of the time, owners want to add back all of their salary. Okay. Sometimes you see, oh, yeah, no, add back $100,000, add back $200,000, add back this. Well, you as an owner, the goal in a successful business is for you to draw a payroll. For this, when we're doing this as an add back, we want to add back anything that is over and above what is market rate. Okay. Anything that's a non-reoccurring expense, such as a legal settlement, one-time marketing expenses because you did like a product launch or something like that. Like James said, he was looking at an e-com business. Okay, if they launched a new product that was, something in the e-commerce, well, they would have some one-time expenses associated with marketing and launching that new thing. Okay. I did one that was a e-commerce business for like medical devices. Whenever they rolled out a new product, we did have non-recurring expenses associated with that product. Okay. We also will add back expenses to the net income or EBITDA. They aim to present a clearer picture of the earning potential. Okay? Kelly, I think you are not muted, sweetheart. If you just want to hit.
Oh, I'm sorry.
No, you're okay. No worries. Unless you had a question. You guys know, and this is also kind of blanket thing. If you guys have a question, come off mute, raise your hand, tell me, spawn up a smoke signal. If I don't see it, Ty, tell me. And I'll deal with you guys' questions. So
You got it.
Key differences between seller's discretionary earnings and add backs. When it comes to the scope of them, seller's discretionary represents a total financial benefit available to the operator. The add backs are going to be the specific adjustments. So essentially, the way we can look at this is add backs add up to your seller's discretionary earnings, which is why they sometimes get interchanged and misused and things like that, is because the add backs ultimately come your seller's discretionary earnings. Now, the purpose of these seller's discretionary earnings are used for us in valuation. I'm actually going to show you guys an example of that. The add backs are used to adjust the financial statements to reflect its earning potential. Okay, so we're putting expenses back in to modify the business. So final things on SDE versus add backs. The seller's discretionary earnings is going to represent the overall earnings to the owner. Add backs are adjustments made to arrive at the SDE. So we want a clearer picture of the business's earning potential, because you guys want to make sure that the business that you're purchasing has earning potential or income potential. That's why we're getting into business. You don't want to buy a dud, theoretically. So case study. You guys know I like a good case study. I love to tell stories, things like that. It helps, just kind of draw home the concepts that we're talking about. So the one that we're going to look at is, and I made a nod to the Friends episodes. This is the one with the cloud tech company that had a COO who wanted to stay. Okay. So a couple of facts about the cloud tech company. Their average revenue was $4.1 million per year. The company originally started with 3 different owners. The one owner was bought out like over 2 years ago, but he stayed on as an outside salesperson and received a commission for anything that he sold. So that left us with 2 owners, and they're the ones that are selling the business. Now you have the CEO and the COO. Now, the COO wanted to stay on in the business and continue working the business. He liked it. He just didn't want to own it anymore. Understandable. Some of us get burned out, but we still like what it is that we do. So now these next two pieces are well, actually, there's 3 of the 4 pieces here that are super significant into what we're going to be looking at. The average sales growth is going to be 5% year over year. Okay. The industry is growing at 13%. So we automatically have room for improvement. Okay. Overhead growth, 6.92%. So the overhead growth is at 7%. Our sales are at 5%. Their EBITDA for 2023 was $343,000, excuse me. And they had a lease on an office that was going to expire in April of 2024. Okay, so this is a snapshot of the actual revenue and profit budget that we did for this particular company. Now, I'm going to use my handy dandy little highlighter over here. And we're going to take a look at a couple things. So with the, there we go. Okay, I just had to figure out where I was. Sorry, guys. So with this, and we're going to pick up the highlighter. Here we go. Now I can actually see it. This is that growth based on the 5% year over year. Okay, so by the end of year 5, we're going to be just short of $5 million a year. So that's a pretty good number, you know, pretty good growth right there. But we have expenses that are growing at 7% year over year. Now, in what we do, I had to like tighten this up to get you guys one snapshot of the revenue and profit budget. So in this, oh, okay, it's just the recorder thing again. So in our original or actual presentations or where we're reporting, we see all the expenses. So we would see where the rent, the payroll, the salaries are, had to condense it all down so you guys had one snapshot. But what this does show us is down here, we have $292,000. And by the end of year 5, we're going to have $8,300 or $8,300 left. Now, so we have a significant decrease. When we have overhead that is growing faster than our sales, eventually at some point, it's going to overtake it and we have no income potential. Now, for this particular company, for 5 years, we have some income potential. So we can actually apply a discounted cash flow valuation to this business. Now, anybody that's not heard me talk about discounted cash flow before, there's 3 buckets of valuation. So you have an income approach, a market approach, and an asset approach. Discounted cash flow is one of the formulas under the income approach, and it looks at the future income potential of the business, okay? So our value on this company, based on historical, no changes, no add backs, just historically, how is it performing? $619,000. Now, me as a valuator, this is one of the things I'm going to take a look at up front without making any changes. What is its value? Where do we sit before we change anything? Okay, so $619,000. How do we arrive at that? We have a discounted cash flow of $413,000. Terminal value, so that's what is the business worth at the end of the 5th year. So we actually have a negative value. What is the cash? So that's going to be the most recent year. So for 2023, they had $210,000. We add any long-term investments and deduct any long-term debt. So this company is carrying no long-term debt. If they have any, it's short-term, so it's getting paid in under 12 months. So that's not bad there. So we don't have any loans that we have to worry about them taking over before the transfer. So that's positive. Okay. Now, here are the list of proposed add backs. The rent is going to be added back except for 2024 because we had a lease that was expiring in April of this year. Of 2024. So the remainder of that was estimated to be about $20,000 for the existing lease. Okay, so 2024, we're going to show $20,000, zero it out for the other 4 years. Salaries and wages, those ended up getting adjusted by a total of $289,000. Now, this took care of the commission for the former partner and the owner's 2 salaries that have brought, you know, roughly in even $111,000 each. Okay. So this is the spreadsheet of the revenue and profit budget once we've made those adjustments. So our sales have not changed. We still left those at 5%. All right. But our expenses have actually dropped because we actually see this down here in the net income. Remember, by the year 2028, they were going to have about $8,200 left in net income. Now we've got $353,000. So we've actually bought ourselves some more time before the expenses overcome. So we probably dropped this closer to maybe a 6%, 5.5% over the sales. Okay, so we have additional time, which, you know, from that perspective, okay, this is positive. Now, one question that I get quite often is, so if we make an adjustment to the financials, is it going to affect the value? The answer is yes. The question is by how much, okay? Is it going to go up? Is it going to go down? It's not necessarily going to go sideways, but we could go up or down and we don't know how much that fluctuation is. I just had this conversation with a consultant yesterday about this very thing. They recasted the financials. So what a recasted financial means is that they've gone into the historical and made these adjustments to the historical financials. They've added back whatever that is, and it's been what they call recasted. So if I have recasted financials, my valuation is going to change. So, or if we make these kind of projections or add backs to this, how does it change? So we now have a value. We went from 618,000 to almost 2.5 million because we have a discounted cash flow now of 1.4. Our terminal value is no longer negative. Now the cash has not changed and there still is no long-term debt. So those pieces don't change. What changed was the calculation because now we have more income potential. So, like we said, sales stayed the same, over an average of $330,000 saved in expenses per year, and the value increased by about $1.8 million. So, for you as the buyer, okay, this is what you kind of have to think about: is am I comfortable running the company in a virtual situation? They've operated the business in an actual office. Does that make sense for you? And you've now gotten rid of 2 C-suites and a salesperson. Can you operate the business with all of those changes made? Okay. That's the question you kind of have to ask yourself as a buyer. That's why buyer due diligence exists, is how are you going to operate the business? Now, remember I told you that this is the one where the CEO or the COO, he actually wanted to stay. Now, the COO, and I had to do everything I could not to laugh out loud when I heard this. So the COO, mind you, we added back in $111,000 a year for his original payroll. He wanted to stay on the business for $250,000 a year. I just saw James's smirk and it made me happy. So with this is, okay, the reality of the situation is we just lost 2 C-suites and a salesperson. Now let's say that COO, he brings stuff to the table. He's got great relationships with the vendors. He's got this, he's got that, he's got great hair, whatever it is that you determine is the reason that you want to keep the COO. Okay. So let's look at what that scenario looks like. Now, again, our sales haven't changed, but our expenses have. Now, at our bottom dollar, okay, net income. In our original historical, by the end of year 2028, we were going to have $82,000 left over. Now, when we did our add backs, we added in roughly, I'm not going to do an exact number, but around $300,000 worth of money that we added back in between salaries and rent. Okay. Well, now we just deducted $250,000 of that. So we've kind of killed a lot of the add backs that we just had. And we ended up adding back about $50,000 left, leaving us with about $103,000 left, and by the end of year 5, excuse me. So how does that affect the value? Well, we're going to have a value of about 1.1 million because our cash flow is 660. We still have a positive terminal value and everything over here stayed the same. So what changes? The sales stayed the same, but the expenses are still growing faster than the sales, like the historical performance, because there was only an average of like $80,000, $100,000 difference. And the value is going to be higher than the historical at $488,000 higher than it originally was, because that's what gives us the 1 million. So what do we learn through the case study? Is just because the seller says so doesn't mean that you have to take it to heart. Okay. You may have to hire additional staff or C-suite employees. Rent is a legitimate question. They were doing work in an office space. Are you going to need to do that for yourself? If you need the office space, that has to be taken into consideration for rent. So I was telling Ty before this started, I actually had kind of went to war almost with a bank over this. And it wasn't necessarily the banker who had the problem. It was the seller broker that had the issue. So it's a t-shirt company. Now that company that we just looked at was a Cloud Text. This was the engagement with a bank because it's got, somebody was going to buy it. We're doing the valuation for this SBA loan. The seller's broker had added in, probably almost $500,000 worth of payroll, the other add backs that were all personal in nature, all of that good stuff. The buyer went and spent a few days on location with the business to see how does it operate. And he went back to the banker and he told him, he was like, hey, he was like, I am going to have to hire at least 6 different people to be able to do this because they've been running the business on a skeleton crew. Well, you know, in addition to the 2 owners leaving, he was going to have to hire 4 more people. So whenever we looked at the estimate of what that payroll would be, it pretty much wiped out almost all of the add backs that the seller's broker had added back in because of how many staff he was going to have to hire. I mean, they were operating with staff of like 8. Well, they were going to leave him at 6. He was like, I need at least 10 to 12 to be able to operate this business properly. So for our valuation, that's what we had to reflect. And the broker did not like it at all because of what the value came back at with those add backs not necessarily getting taken into consideration. So the thing I want you guys to take away from today is that just because the sim or the prospectus or whatever paper they give you that says, hey, we got to add all of this back, that may be true for their personal expenses, but consider how you're going to have to operate the business and take those things into consideration to make sure that you guys are having the best deal possible. Okay. So seller's discretionary earnings. So like we said, add backs are all the things that add up to the SDE, but we use seller's discretionary earnings for valuation purposes. So we specifically use it in a market-based approach. So this is an actual example from a report that I just provided to a broker just a couple of days ago. So obviously this has no company or no name information, and it's just the financial statements. Now, what this company does is that if anybody went to private school like me, you had to, and I think some public schools do this too, is you have to go to a uniform store and purchase your uniform so to you know, stay with the dress code. What this company does is that they actually sell those uniforms, and they also do the embroidery to them for the school's logos or, you know, crests or whatever. If I never see a jumper again in the rest of my life, I'll be happy because I had to wear it every Wednesday for 5 years. So that's what this company did. Now, what we see here is their income statement. Now, whenever we look at this from a market approach, is we're looking at what's the revenue, what's the net income. Now, this is where we get into the add back situation, okay? How add backs end up adding to SDE. These are going to be our one-time expenses. Now, I'm specifically looking at 2023. They provided me 3 years, but the averages were so close, or the numbers were so close, we just went with the standards. So we have one-time expenses of $65, almost $66,000, and the owner's compensation was $129,000. Okay, so we are going to arrive at a seller's discretionary earning of $425,147. Then we also have the balance sheet information over here. So we're going to look at the assets of the business. So there's our total assets. These are the liabilities that we took into consideration. Again, this company had no long-term liabilities. And fortunately, these two things balance. 466, you know, we're off by like $1. So that's within the realm of possibility. Now, market approach is very similar to whenever you try to purchase your house. It's your house versus other houses that sold. So it gives you the value of your house. The market approach is very similar. We want to look at other transactions of other businesses that were close to you. So what this is an example of is that there's about 4 to 5 different databases that carry these transactions. So I actually use BizComp. So this is actually a snapshot of the transactions that we pulled for this particular company that were close. Now, whenever we use the term close and kind of the downside to marketability is sometimes they're not close in age, sometimes they're not close in revenue, sometimes it's our only categorization that we can make to try and determine the closeness is their tax codes. And that's what happened in this one. Is all I could use was their NEICS code because there was only 3 transactions available. There was nothing close to them in revenue at all because they were such a niche industry. Now, if we were talking about a restaurant, if we were talking about a daycare, if we were talking about a home services company, we would be having a completely different conversation. We could get super specific with the transactions that we chose. So we had, yeah, Dean, question, shoot for it.
Is this kind of like real estate where it's public information and you can see all the companies that sold, or?
No, this is not public information. So we actually utilize so we actually pay into BizComps to access this data. So it's unfortunately it's not publicly information. There may be some that are, but for us, like it's using Pratt Stats or BizComps or something like that. It's prior transaction data, and it's filled by business brokers or transactions that have happened. So these aren't necessarily publicly available. So that's whenever you have to use somebody like us, a evaluator that can actually pull the transactions to do the comparisons. But great question, Dean.
Thank you.
So, so here's how we actually equate to the value. How do we actually arrive at where we are? So we have price to revenue and we have price to seller's discretionary earnings. Okay. So this information here from mean, median, harmonic mean, and coefficient of the variation, this is all information from the transactions. Okay. Now we all know what mean and median are. We learned that in algebra in high school. And even though we told our teachers we'd never need math again, here we are needing math. So I have to apologize to Mr. Rutledge. He was right. Okay. So harmonic mean is basically used in finance for an average of price multiples, which is exactly what we have here. First time I saw it when I was studying for my exam, I thought it was like, okay, what does a harmonica have to do with mean? I have no idea what this means. Well, it's actually not even close. It's averages. So guys, that's as good as the jokes get. If you didn't laugh at that one, I have nothing better to give you today. Okay, I'm sorry. Now the coefficient of the variation, okay, so this one here after the harmonic mean is the standard deviation away from the mean. Now, the lower the ratio, the better the risk, okay? Now, I'm telling you that because it's actually significant to something else. So down here, we actually will assign a weight to the two different ones, price to revenue to SCE, and that's what we do as valuators. Now, every evaluator will tell you that valuation is a mix of art and science, and it is, unfortunately. It is kind of our opinion of what it is that we think. Fortunately, what we can do is that we can take a look at some different factors. So if we are looking at something that is more service-based, okay, or more of a smaller business, we may put more weight into the price to revenue, okay? But if we're looking at something more consumer-based, we may have lower to negative net income, making the SDE more of a weight that we would go with. Okay, so sometimes we made it evenly. Sometimes it's a 50-50, and a lot of times it's based on evaluator's opinion. Now, for us, the other thing we can take a look at is the coefficient of the variation. We can look at, okay, how low is this number, and then make our weight based on that. So in this particular instance, since the coefficient is lower, this means we have less risk if we look at a price to SDE. So in this particular case, we looked at an 80% versus 20%, which when we do math over here, which I'm not going to bore you guys with all the math, I did all of it last night, making sure all of this was correct for today. So that gives us a value of 1.5 million. So that would be an effective market value of this business. And if we look back at what they did as far as an income, it's a $1.3 million business, $1.5 million valuation. So we're pretty close. He thought it was worth 3 million and we had to pop his bubble a little bit. So what are some examples of some add backs? This would be owner salary adjustment to market rate. Now you guys are going to ask me, how do we figure out what the market rate is? Well, the market rate is going to be industry specific. Okay. Unfortunately, we do some research on it. The other thing that comes into play is what state that you're in. So I am in the great state of Texas. Florida also, we have very similar in that there's a tax that we don't have to pay. So we're basically twins. If you're in one of the other states that does have that, we have to take that into consideration as well. Okay.
So if you can't do that, okay.
Ashwin,
You
I
have
think
a
you
higher
have
risk of,
you're not on mute, sweetheart. I'm sorry. I think I'm hearing myself. So personal expenses, unless you had a question, darling, I'm sorry. I didn't mean to cut you off unless you had a question.
Nope, that was my fault. Sorry.
Okay, no worries. All right. So personal expenses could be personal travel, any entertainment. If you bought Taylor Swift tickets, you let the company pay for it. We're going to have to add Tay-Tay back into the expenses because it's not going to happen. And then any personal vehicle expenses. So the company is paying for your insurance, your inspections, your smog test, your whatever, those would get added back in as well. Now, non-recurring expenses. Relocation. I am working on a healthcare valuation right now for a business and marital divorce. And they literally relocated their business right in the midst of it to where they went to some place that has to be appointment only as opposed to someone being able to walk in. So any of those costs that are associated with that relocation, the moving, anything they had to pay for as far as build outs or something like that to that new location, that can be added back in. If they have to settle a legal dispute of some sort, that would also be backed in. Launching a new product line, like I mentioned earlier, we had an estate and gift tax valuation that was for a medical device company, and he launched a new product. About every 2 to 3 years, he launched a new product. Those would get added back in. If you have any excessive perks or benefits, that could be considered a luxury vehicle, club membership. I had a survey company that I valued twice last year in 3 months because they were doing partner buyouts, and their country club membership was included in there because they took their vendors and their customers out to go play golf, and they took them out for rounded for 4 hours, got them liquored up, and hey, they're our survey company of choice. But that would actually be considered a personal expense, okay? Or if you have any extravagant meals or something like that, that would also get added back in. So I am now going to open up the floor to questions. If you guys would like copies of the slides, my email address is at the top. Shoot me an email and I will send you guys the PDF. Ty, I will also send you a PDF of these as well if you wanted to post it with the recording of today. I also listed my phone numbers, my email address, and my LinkedIn if you guys have additional questions. You just want to have a conversation, you want to pick my brain, feel free, reach out. I can help answer any questions, and I will open the floor to any questions you guys have, whether it's related to SDE, add backs, or valuation in general. Fire away.
Yes. So yes.
Yes, okay. All right, James, hit me with your best shot.
So the business that I have a verbal LOI on,
Okay.
he sent me some preliminary financials that his accountants are working on, right? So it's an e-com business. It's part of a larger company, right? So he's got a corporation or whatever, and then he's got 2 separate websites. The website that I have submitted the offer for is presumably killing it, right? It's doing well.
Okay.
Secondary website, not. So they were doing really well, and somehow this other line of business is bleeding like $1 million a year, right? For like the
Okay.
past couple of years. So how does that look? So for example, so he's already spun down the other business, right? So as far as stopped running ads, right? So that was really where a lot of his cost loss was running excessive ads. I don't know if he just kind of let them go and it wasn't really paying attention. I don't know the reasoning behind it. But they spent like 1.5 million in ads last year on a business that the margins aren't that great, and they only did like 2 million in revenue, right? So I guess kind of what I'm getting at there is he's adding some ad backs, right? So he's carved out himself, or having his accountant kind of carve out the secondary website, right? Like the main website, and then carve out all the other stuff, right?
Okay.
Some of the ad backs he has is for the main website, cutback opportunity. So overstaff cutback opportunity. So he's saying there's a couple $100,000 in cutback opportunity, aka fire people, I'm assuming.
Mhm.
So I mean, if it's that simple, why the heck hasn't he done it? Is my question. I don't know if that's a legitimate ad back from your eyes, or maybe from the bank. I'm not sure. And then the secondary part was a one-time expense for poor advertising. So he did some like testing on advertising, right? That failed miserably, basically. They were like trying some new ad formats and trying some others, failed miserably, lost like $300,000, had a horrible, and so then he's also trying to add this back, saying, hey, one time marketing adjustment. And then there's another one where it's they had some, because Google did their big transition over to Google Analytics 4, and I kind of believe this one, right? They have a large catalog. It was a huge expense to kind of transition their business to the new Google standard, right? So Google Analytics
Okay.
Universal to 4, which that one I can almost believe, because that was an expense for a lot of businesses.
True.
To adapt that, right? But I guess how do you as a valuator look at those, and then how would a bank look at these, right? Or would they say, yeah, right, you're crazy?
Well, the bank, most of the bankers that I know, I have very frank conversations with a lot of the bankers, and a lot of it is the usage of words that are used by sailors and those of us who like to use enhancement words in our language. I am one of those people that use those enhancers. So they may give you one of those enhancers when they look at it and say, what the fork? I'm cleaning mine up because this is a presentation and it is being recorded. So the bank may say that to some of that. Now, for me as a evaluator, what I'm going to take a look at. So if I'm looking at this for you on a buyer due diligence position, I'm going to say, all right, this is the list of ad backs that they've given us. These are the ones that I'm like, I don't necessarily see this necessarily being an ad back, but I'm also going to say, all right, from a marketing perspective, the industry is using X amount of dollars. So this percentage of the total sales for a marketing campaign. If they're within that realm or within that percentage, then you have the opportunity to say, okay, it's not really an ad back because it's within market acceptable standards. Okay. So it might not necessarily be an ad back, but we don't know until we look at what does the industry tell us. Okay. As far as, like operational or like potential cuts, basically fire people, that's not necessarily going to be a legitimate ad back because he hasn't done it. I mean, if you see that you're going to need to reduce some payroll or whatever, that's going to be up to you, and that's a decision that we would have to make through that conversation. Take a look at that. Okay. I wouldn't look at that as an automatic add back because it hasn't historically happened, nor is it proposed to happen. If he's not going to do it, like you said, if it's so easy, why didn't he do it? It sounds like he's just trying to add things back in to boost his value, which is what we saw in that, that case study I looked at. We added in $300,000. It's like, okay, that boosted the value what was it, $1.4 million. So that's what we would take into consideration. So it's really looking at what are the ones they're going to take a look at. The banks are going to claim the ones that they would see. So a lot of the ones that we looked at, payroll, one-time expenses, taxes, amortization, depreciation, earning, those are the ones that the bank is primarily going to take a look at. The seller can make their case for the other ad backs to the bank. But a lot of the time what ends up happening is while the bank may not take ad back A that they claim, they may take ad back B that they saw that the seller never even took into consideration. So a lot of the time it doesn't end up balancing out. Sometimes it doesn't, and the bank's like, okay, you have it valued at 4.2 million. I can only justify 3.5 million. It's up to you as the buyer to say, okay, I can only, bank's only going to loan me 3.5. I'm only going to buy it for 3.5, or for some reason you just have a hair about this one and you want to make up the difference. The bank will give you the 3.5. You can make up the difference. I have seen that happen. I had a conversation with somebody just about 2 weeks ago about this exact thing, and he just had to buy this thing. And I'm like, okay,
Sure.
Charge on, my wayward son, whatever it is that you would like to do. I can only give the information possible, or the most information possible, to make the best business decision possible. But at the end of the day, that decision lies on you. So what I would tell you, James, is that it would be looking at what are the individual ad backs specifically that they're looking at to arrive at the value. Then, having a conversation with the bank as well to say, hey, here's what we're, this is what he's saying, because a lot of the bankers, a lot of the lenders will work with you to help you understand, okay, this is our process, this is what we see. And at the end of the day, if you're doing an SBA based valuation, they're either going to contract somebody like me, or if you've done the preemptive strike and you come to me independently, you pay me out of pocket for a certified valuation, take it to the bank. 9 times out of 10, the bank will accept your valuation because it follows the form that they need. And then that's something you don't have to roll up in your closing costs. Okay. So that's something else. That's kind of like for everybody here. If you're looking at SBA lending, the bank will order one, but if you come in with one, most of the time they will accept it. And sometimes they'll even call us and have a conversation with us just to understand the process, or how do we arrive at it if they have a question, and then they'll accept it. So that is something that's possible, because I have a doggy daycare that's doing that right now.
Okay, I have one second part to this same question.
Okay. Josh, I see your hand raised and coming to you next, darling.
Yeah,
Yeah, no worries.
I'm just cutting off Josh. I'm just trying to, like cut off as much time as possible for Josh. No, I'm just kidding.
Thanks, James.
I'm just kidding.
I stay as long as you guys need me. Okay, you guys have my full and undivided attention.
Perfect. So the second part of that is, I've floated the idea of a stock sale, for this purchase, right? Because it's like a 30-year-old business. I like the idea of acquiring a 30-year-old business entity. I like the idea of having instant access to lines of credit. There's lots of benefits to it, right? Everything stays in place, payroll, et cetera, et cetera, et cetera. But how does that look? So let's say, for example, this scenario, he's got two businesses under the corporation. One was losing money. It's no longer losing money, right? So it's essentially just kind of on autopilot, right? No more ads. It's all organic and existing customer reorders, whatever, right? So they're no longer aggressively pouring money into this business. The other business is making money. When you're looking at evaluation, is it primarily forward looking? Or is it like, how much of it is to the reverse, right? When you're preparing this. So for example, obviously if you looked in the reverse, it's going to look a lot worse, for both of them
It's not going to look
combined.
positive, right? So it's a great question. And I hate the answer, but it depends. So we will do, under the income approach, and we'll do a capitalization and benefit. So we talk discounted cash flow. That's all future potential. We would also look at a capitalization and benefit, which is only historical. We wouldn't look at anything into the future. We would only look at the history. For a market-based approach, a lot of that is historically based on, what has it done in the past, but it's also more looking at what was the most recent year versus the market multiples. And then obviously an asset approach, but in this case, since it's a going concern, we wouldn't put any weight into an asset approach anyway. So with what you're looking at it doing, like a stock sale, or basically, what you're proposing is basically walking in and taking the big chair over. The things that we would verify and we would take a look at, and this would probably be also on a business attorney, would be any liabilities or liens or anything like that they had. As long as all that was free and clear, you'd be solid. The thing with us, and I actually had one at the end of last year evaluation I did on a restaurant, is that the CPA, when he looked at it and valued it, he used an algorithm based, which only looks at historical. And the historical value of the company was under $500,000. When the woman flew in from Colorado to meet with me here in Houston, and we sat down, we had a conversation. She explained to me, we moved the restaurant, we doubled its capacity, we raised the prices, we did this, we did that. That raised the income potential of the business significantly. So it sounds very similar to what you have, James, here is, okay, they've cut out a lot of ads, they've done this, they've done that. It sounds like they've maximized a lot of the income potential of the business. So for me as an evaluator, I would most likely lend more towards a discounted cash flow valuation of the income potential of the business, because of what is possible from the income. But the other thing I would take a look at is, what is its historical growth? What's the industry? And, what kind of impact have those changes made? Because if there is that possibility, unlike what we saw in that case study where the overhead's growing faster than the sales, if we have the reverse and the sales are growing faster than the expenses, then we have some pretty healthy future potential. So I would put some serious consideration into a discounted cash flow or future value.
Okay, awesome. Thank you so much. I'll have to email you.
Please do. All right, Josh, you're up. You patiently waited. Thanks so much. What is your question?
No worries. No, I appreciate it. Thanks, James. So just to it was around a similar question that James was asking on SBA lending. What is the more likely valuation method that I'm expected to use with SBA lending? Because the recommendations I've got from every bank on every deal I've looked at has always been based on historical, and there's not been a consideration of forward-looking in any case. So I'm just wondering what you normally see in support of SBA lending.
All right. And this is speaking from my experience only. Okay. So this is my experience and what I've done as a evaluator for banking related valuations. I have only used the market approach one time on a bank related valuation. I have used discounted cash flow more often than I have used capitalization of assets. So looking historical,
Okay.
I primarily have used discounted cash flow. Now, again, very similar to what I told James, it is dependent upon the business as well. If there is significant income potential in the business and there's that opportunity there, then the discounted cash flow would make sense. And the thing is that me as a evaluator, I have to justify why I picked the valuation that I picked. Like I have to literally have to detail out why we made the opinion or made the decision that we made. Okay. So if, you know, and like asking the banks are saying, oh, well, you got to use a capitalization of benefits. Where in the world are they picking that out? That's my first question is why do you automatically say capitalization of benefits? Because have you looked at the discount rate? Have you looked at this? There's a myriad of factors that we look at in the course of evaluation. And if the banks are saying, oh, capitalization of benefits are a market approach, which would be your historicals, what have you looked at to say that's what it is? Because for me, I'm going to look at every approach available. I'm going to look at both incomes. I'm going to look at market. I'm going to look at asset. You're going to get 4 to 5 different valuations from me in a certified valuation SBA situation. Okay. And then of those different calculations, I'm going to pick like 1, maybe 2, and then weight them from there. But I also have to prove and I have to justify why I chose what I chose. So until you've actually looked in and you've looked at the discount rates, you've looked at the industry information, you've looked at the income potential, you looked at the market, you know, market multiples, you really don't know which value you're going to choose till you get to the end.
Gotcha. Okay. And then secondarily, I'm looking at a business that essentially has 2 entities that the owner is trying to sell. And obviously he would like to roll that cash flow up to have a higher multiple.
I bet you would.
But yeah, well, absolutely. So if I look at that though, the entities are, the only commonality is that he manages them both and they are in the same location, but they are truly 2 separate businesses. So they
not
do
same
separate
industry, they're separate.
So they're in a related industry. They actually create referrals across to each other,
Okay.
but they're 2 separate businesses in that they perform separate functions. One is a landscaping and mowing company. They
Okay.
go out and mow and blow. And the other one is a hardscape company that does like complete renovations, pool renovations, backyard renovations, all that stuff.
Outdoor kitchens, things like that. Yeah, I'm doing one of those right now. Yeah.
So is it reasonable to think in evaluation that they would be rolled up together, or would you maintain those as separate?
Okay. If he is selling the enterprise, which is the 2 companies all rolled up together. Okay. So, all right, you have individual entities. Okay. But if you have, because the healthcare company I'm working on right now. Okay. Example. I have a healthcare med spa. So they do like weight loss, Botox, hormone replacement therapy, all that jazz. Okay. So that's entity 1. Entity 2 is a management company. So the healthcare company pays a management fee to the management company. Management company pays most of the bills for the health spa. Okay. Now, I'm actually doing a valuation on the enterprise, which is both of these companies added together because they are considered what's called a pass-through entity. So we have a PLLC and an LLC, which means cash can flow directly through from the med spa to the management company without being tax effective. Okay.
Yeah, okay.
So that is going to be a key situation for you in this particular instance is, are they both LLCs to where there is that cash flow ability? Or if they're 2 separate corporations, like an S Corp and a C Corp, or 2 S Corps or 2 C Corps, then there's going to be certain tax affected situations that would, in my opinion, I would value them separately as opposed to rolling it all into one enterprise because of how the taxes will affect it.
Okay, yeah, that makes sense. One is an S Corp, one's an LLC, so they'll be taxed differently.
Okay, yeah. So, you know, since even though they can refer each other and they're, you know, they're sister companies essentially because they're owned by the same company, they would refer business back and forth. It's not like the hardscape companies paying the landscapes bills or something like that, like what we see in this instance. We see this a lot in the healthcare industry where there's management companies, and this one got super complicated real quick. And I'm like, okay, y'all need to draw me a diagram. And they did. But for you and what you're looking at with this, I would take a look at the landscape company as an individual, the hardscape company as an individual, and then basically work yourself 2 different deals. You know, that way, or however it is that your broker or professional wants to handle that part of it. But I would look at it as 2 separate valuations.
Okay, thank you. I appreciate it.
You're welcome. Okay, there is 6 minutes left of the allotted time. So is there any other questions from anybody else? Let me stop sharing the screen. Hopefully you guys got everything that you needed as far as contact information.
I can share it after the fact too in the group chat
Awesome.
in Slack.
Cool.
Anecdotally, so what I've heard, you know, the way people kind of explain it is that it's almost like real estate where the valuation kind of usually just lands where it needs to. You know what I mean? It's like, oh, what a coincidence. This house is selling for 750,000. It just so happened to appraise for 750,000. You know, so I've heard people make similar references to like business because it's like ordered from the bank. And so how often are the valuations, do they come in, or, you know, is it more often than not they go under? You know, does that depend on how the broker's pricing it, I guess, or
It
you see
depends on, yeah. So if the broker, if it's been priced appropriately, okay, it's not been a pie in the sky, you know, thing. I talked to somebody, they had a event service or an event venue that had a book of business and all these future bookings and da 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 da. With real estate, they were listing it for like $11 million. Well, the bank could only justify like 6. And so, you know, it's one of those things where, you know, in that particular instance, there's been an unrealistic expectation set, so it's not going to come close. If we're in a realistic situation, so I had one that came from a bank. It was a like a decorations company, think kind of like independent Hobby Lobby, essentially, is kind of like what it is. So they valued it at just under $1 million. It was like around $800,000. Well, my value of it came in around 700,000, you know, 725. So most of the time, as long as there's a realistic value there, we're within about, you know, $200,000-300,000 either side. And that's usually an acceptable range, okay, of what the banks will accept as the value. If it's dramatically over, if it's over like $500,000 either way, that's whenever the banks kind of start having a question, or they start calling us saying, hey, you know, is there anything we could do? Da 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 da, changes, whatever. Now, me as a valuator, okay, so this is just kind of standard across the board. If any valuator gets told, hey, the value of this business is $3.5 million, I need you to help this value to be $3.5 million, it ain't gonna happen. You know, it's gonna be, we're gonna calculate it based on what we see. If we happen to get close, awesome. But if it has to be $3.5 million, it's not going to happen. Like, we can't guarantee that that's going to happen. And that's how it is. If they did, there might be some ethics things going on there. But, you know, if we actually get close, and what's kind of interesting, and actually makes me laugh, and, you know, actually kind of makes me happy sometimes when it happens, is that, you know, if we get within like $20,000 or $30,000 of whatever the target is, it's like, okay, everybody did their job, everything hit, it all looks good. But never is it, okay, we listed it at 2 million and the value came out at 2 million. That doesn't exactly happen. So, you know, and in realistic situations, like the one I was telling you guys about, where the seller broker got super ticked off because they had valued it like way over, like he had valued it like 4.5 million. Mine came in around 3, and he was all mad because, you know, well, you didn't do the add backs. Well, no, I didn't, because he has to have more payroll. So it brought the value down. So in those situations, there's nothing that we can do. It's between, at that point, the buyer, the seller, and the bank, and what do they want to do. We've given our opinion based on what we have. And that one actually was a discounted cash flow valuation. You know, it was, this is the best income potential that we can find with the discount rate that we have. You know, the other thing that I'll tell you guys, and this is something that, you know, you'll see in the valuation process, and Ty, this may be something else that we've set up a follow-up training on down the road, is how marketability and controlled discounts impact the value. I have a home healthcare company that's like a private duty, where they send someone to somebody's home. You actually have to have a license to be able to own that kind of business. So your pool of potential buyers goes from being like a sea of people down to a very small pond of people. So a marketability discount would be applied and would actually be rather high because of that restriction of that license. So if you're buying into a business or into an industry that is like that, then a marketability discount gets applied because of the lack of potential buyers. The same thing for controlled discounts. If you're buying equity into business, now most of you guys are probably buying 100% interests in business. But if you're looking at purchasing equity interests into a business, then there are certain controlled discounts that actually save you a little bit on that equity, that 20%, 30%, even if it's 49%, there's going to be a certain level of control discount applied to those. And sometimes both of those, the marketability and control discounts, both get applied. So that's something else that can enter into a valuation situation as well and bring values down because there are certain discounts that are applied. There's a third one called a block discount is too, but we don't deal with those super often in small to mid-sized businesses.
And James, I can't resist the temptation as a former banker with a lot of real estate. You know, what you described was an urban legend that did happen many, many years ago. But with so many changes in banking laws, any banker that gets caught wiggling with an appraisal has some federal jail time in front of them.
Gotcha. So yeah, and it's one of those things I never experienced myself, but it's one of those things that, like you said, probably an urban legend of sorts, right?
Well, I'm old enough to know it did happen once upon a time, but it got wiped out decades ago. And anybody that still may do that, you really need to check credentials.
Yeah.
Doug, I 100% agree with you. And I love that you're a business maker. You chimed in. I feel like you could have a very interesting podcast with some of the stories that you have from your history.
One question. So when you get a business or when the bank orders the business valuation, I feel like I might have asked you this before.
Okay.
So when you get the business valuation, is there ever a problem if it comes in way higher? Like, does the seller see that and then like, whoa, wait a second, or does the broker get it? Or does it solely just go to the bank who's doing right against the price that you're trying to lend on? Is it just on your buy side or?
Yeah. So for me, if the bank has contracted me, my engagement letter is with XYZ Bank on behalf of, ABC Corporation or LLC to perform the valuation. So my report goes directly to the banker, and Doug can talk to this probably beyond what happens after it hits the banker's desk, but I do not distribute it to anyone else besides the banker that contracted me. What they do with it after that fact, now, we have certain stipulations in our engagement letters and our appendixes in our valuations that actually prohibit some distribution or unnecessary distribution of the valuation report. But as long as it's someone that is related to the deal, a legal professional, financial professional, or something like that, or the actual client, it's up to the bank to decide who gets to see the report after the fact. So that would probably be a Doug story for like after it hits their desk. But for me, it goes to the bank and then I'm done.
Got it. Duly noted.
So
I appreciate it.
Absolutely. No, it's a good question. And no, you have not asked me that question before.
All right, everybody. Brittany, thank you very much for walking us through all this, and we will definitely have you back.
Thank you. Yeah, no problem. Anytime. And like I said, guys, if you guys have questions, you just want to walk through something, whatever, reach out to me, let me know. And Ty, I'll get you the PDF of the slides yet this afternoon. I'll get that in your inbox.
Great, and I'll share that with everyone in our Slack.
Awesome. All right, guys.
All right. Thanks, everybody.
Bye, everybody.
Thank
Have
you.
a good day.